In this chapter, we will be covering the sale of non-current asset, and in doing so, we will also recap on depreciation. Depreciation occurs because non-current assets are exposed to wear and tear, and they are also getting outdated as the years goes on. Depreciation is being provided on a yearly basis. There are two ways to calculate it. First way is using the straight line method, where the amount is the same for every year. The second method is the reducing balance method, where the amount is a decreasing amount across the years. After we get the amount, we will post double entry where we will debit depreciation expense and we will credit accumulated depreciation. Using the straight line method, we will use percentage times cost or cost minus script value divided by useful life depending on what the question gives you. Whereas for the reducing balance method, we will have to calculate every year using percentage times the net book value, where the net book value is actually your cost minus your accumulated depreciation. After we have calculated the amount, say 24,000, we will post the amount in a double entry where we debit depreciation expense. So go to your depreciation expense account and debit 24,000 and credit your accumulated depreciation account by the same amount. Since depreciation is an expense, we will be transferring the amount to the profit and loss account at the end of the accounting period, which is the same day. Whereas for the accumulated depreciation account, it appears in the balance sheet and hence we will be balancing what down. And here you can see that the depreciation per year will appear in the income statement, 24K, whereas the amount in the balance brought down will reflect the accumulated depreciation or your total depreciation in your balance sheet. Although non-current assets are being used to earn income, sometimes we could sell the older non-current assets to replace them with newer ones. So when we sell them, we either get a gain or loss on the sale. If our sales proceed is more than the net book value, we get a gain. If the sales proceed is lesser than the net book value, we get a loss. And we will present this gain or loss in the income statement either as other income or as one more expense. Let's take a look at this example where the business purchased a non-current asset where it is being depreciated using the straight line method using 20% per year. 3 years later, the business sells the system for $20,000. We can draw a timeline to indicate the purchase date and the selling date. With the questions telling us the year end, we will be able to establish how many times it is being depreciated before it is being sold. Since it is using a straight line method, the depreciation per year is constant at $5,000 each. The net book value before it was being sold is $25,000 minus the total depreciation, and this gives us 15K. The business is able to get 20,000 back, so this results in a gain. Let's take a look at a second example where the business purchased 3 treadmills for $75,000. Each treadmill is expected to last for 5 years, and at the end of 5 years, they can be sold for $5,000 each. This is the scrap value. After 3 years, the business sold one of the treadmills for $15,000 cash. Again, we draw the timeline where we indicate the purchase date and the selling date. Here you can see that between the purchase date to the selling date, all 3 treadmills were being depreciated 2 times. First in 2011 and second in 2012. On 10 March when it is being sold, one of them will be sold off, whereas the other 2 will continue to be used and be depreciated at the end of year 3. Using a table, you can separate the equipment into the different columns, and you'll be able to see that for treadmill A and B, they will be going through the following depreciation tables. And for treadmill C, it will be sold and will not be depreciated at the end of year 3. As we prepare for the depreciation account, we can prepare the depreciation on a yearly basis. So in the first year, 12K, we credit it and balance brought down. In the second year, we do it again and we balance brought down 24,000 for the accumulated depreciation account. And in the third year, before we can depreciate the third time, one of the treadmill was being sold on March the 10th. So this treadmill has to be removed from the existence of the company. We do this by putting it on the debit side. End of the year, we will still have to carry out a depreciation for the remaining 2 treadmills. This add up to $8,000 that it can be seen here. Focusing on the treadmill C which we sold, the cost of the treadmill is $25,000. Since $75,000 is for 3, so 1 is $25,000. The accumulated depreciation up to date is 8K. This gives us a net book value of $17,000. We are receiving $15,000 in cash, and that means we are going to suffer a loss. As we prepare the sale of non-current asset account, we transfer the cost of $25,000 on the debit side on the account. This means that we are crediting the equipment account. And it makes sense because the equipment is leaving the business. On the other hand, we will also be transferring the accumulated depreciation account, $8,000 on the credit side. That means we are debiting the accumulated depreciation account. If I were to point to you the previous slide, you can see that this took place here. You debit your accumulated depreciation account and you credit your sale of non-current asset account. Finally, we receive the cash. As we debit the cash in hand, we will credit the sale of non-current asset account. This gives rise to a $2,000 debit balance in the account, which we will then have to transfer to the P&L at the end of the accounting period to make it to zero. It's a loss if it's appear on this side. It will be a gain if it's appearing on the debit side. The income statement will look like this. Remember that we have 2 remaining treadmills that we have to depreciate at $4,000 each. This gives us a depreciation expense of $8,000. At the same time, we make a loss on the sale of the third treadmill. This gives us $2,000 loss on the expense side. And in our balance sheet, we will have the 2 remaining treadmill in our balance sheet. In our balance sheet, we have 2 remaining treadmill at $25,000 each in our non-current asset account. Our accumulated depreciation is $24,000. We have to refer to our accumulated depreciation account, and here you have it. The $24,000 credit in your balance brought down will be reflected in your balance sheet. And finally, the net book value is gotten by using the cost minus the accumulated depreciation.